Buy the rumor, sell the news. That was the theme of the day today. The market started the morning strong after a late Friday night Senate passing the tax reform bill. The market loved it overnight and into the morning, but couldn't hold those gains, those higher gains. So I'm going to break down how we started, what happened during the course of the day that pulled us back, what's rotations going on in there from a macro level, how that's impacting risk appetite, and how we can trade this strong rotation that's going on. So let's go ahead and get started. My name is David Settle, and this is my market outlook for today, Monday, December the 4th, 2017. Thank you very much for watching tonight. Welcome to those that are watching for the first time. Subscribe to my YouTube channel by clicking that red subscribe button that's down there below the video. Hit the thumbs up icon right next to that button. Let me know that you found today's video useful. It's a one-click feedback to let me know that you liked the video today. Scroll down even further and comment on anything that stood out to you from today's video, including light bulb moments, anything new that you picked up. In the video description, there's multiple links for you, including one to subscribe to my daily email newsletter for the Market Outlook video. Follow me on Twitter for more content in addition to these videos throughout the day and throughout the week. My handle's on the screen at DavidSettle42. Pinned to the top of my timeline is tonight's Market Outlook tweet. Make sure you like and retweet that tweet there. And of course, join the Market Outlook community on Facebook. You'll see the link at the top of the screen to join. It's also in the description of the video down below. All right, let's take a look at the S&P 500 with the market forecast indicator. And really quickly, you'll see I'm on the profit chart still. You probably noticed over the weekend, some of you that still use the profit charts that on your live trading platforms it's not available anymore. It still is in your paper money, and that's why you'll see it here, but not on the live. So because of that, and there's a lot of great features here. I'm working on the ability to use another charting package to replace the profit charts. And yes, there's a Thinkorswim charts too, but I'm working on another where we have a little bit more flexibility and a little bit more opportunity to get what we want in a charting package. So stay tuned for that. That'll be something we want to be using in our classes. And to kind of give you a heads up of what's going on there, Brandon and I are working really hard at getting ready to go. And our goal is by the beginning of the year we can launch with our educational offering that a lot of you have given us some great input on. I think we got over almost 1,100 surveys back with great input on what you'd like to see in this offering. So we're working really hard on that. We'll have some more information in terms of like a soft launch here pretty soon. So with our name and our website and logo and all that stuff. So that's coming soon. But beginning of the year is when we're going to launch our offering to you all. So stay connected with us through these videos, through social media, and through the email list that's in the description of this YouTube video. So just a little update there. I'll keep you updated, but we're really close to announcing some new information that's going to be really exciting. So we're really looking forward to that. All right, so look at the charts here. So we can see got a strong bullish posture, intermediate lines in that upper reversal zone, near-term lines coming down finally. You'll see we got a engulfing pattern here. So we had that long lower shadow with the Flynn news on Friday, and then today, and if I don't know how many of you saw, I posted this on Twitter. Yeah, the market was up 0.75% this morning because we gapped up big over the weekend with the Senate passing the tax reform bill over Friday night, late Friday night. So we gapped up, but you notice that we were already trading around 266 on Thursday. So we pulled back, and Friday morning we were trading at 265. So if you take out this Flynn-related news that the market pretty much recovered from by the end of the day, and obviously over the weekend, I mean, if you take that out and you just kind of move this up here, you notice that's not very big. That's not a very big move at all. And by the end of the day here, you can see we ended up falling back down into that area, into this. So you can see, I mean, there was your buy the rumor, and we kind of sold the news off by the end of the day and came down into a close. So we actually fell from today's high point more than 2 points on the S&P 500. So That being said, we ended up with this, big old Harami, long lower shadow we talked about, which is bearish, but not as bearish as long upper shadows. But you see, we had a long upper shadow on Thursday. I pointed that out on Thursday. We got roughly another long upper shadow. And remember, we're not looking for long. You're not going to get long upper shadows that are, that are this long that we see here on the downside, unless they're at the bottom of extended moves. Because we usually don't get big volatility at the end of upward moves. Usually the VIX is pretty darn low. So when you're in the end of upward moves, you're going to, any kind of long upper shadow tends to be pretty bearish. You just don't see those. You see, like during this rally, we just didn't see very many long upper shadows. You ended up with an engulfing pattern. Then you started to see some here, and we had some weakness finally. And so, this is bigger than we've seen in a while. These upper shadows, 2 of the last 3 days, with the third day in the middle being a really, really long lower shadow, which again can be bearish at the end of an upward move, just not as bearish. So that's the basis for our hanging man candlestick pattern. The fact that we close back at the high of the day, makes it less bearish, because the close is what matters. Right here, we close at the low of the day, and that's what makes today's move more bearish. And you can see it was an engulfing pattern, long upper shadow. Bearish candlestick patterns all around, but still strong bullish posture because the intermediate line's dropping, but it's still above 80, and still you have market sentiment up, right? Well, it's just a smidgen below 90. So very, very elevated long-term trend, very elevated, very mature intermediate posture, and for that matter, very mature near-term posture. You got 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12 days now that the near-term line has been above 50. And of course, of that last near-term low points right there. So here's these Fibonacci lines. I've got retracement lines are going to be measuring the near-term pullback. We've already pulled back to the 23% Fibonacci retracement. You can see, before we move that up, the low was right around the 50% Fibonacci retracement on Friday. Of course, moving it up today changes things around. And here's your intermediate. If we move this intermediate line up, because we're still on this intermediate move, brief bearish posture, but not strong enough to change the trend. So again, just getting back down to this old near-term low point would get us down to a 38 to our most recent. Just getting back down, just doing a 100% retracement of the current near-term run will get us back down to a 38% retracement of the intermediate run that we're on right now. So that's how big this is. You usually don't get this big of a near-term move at the on your last near-term run. We have before, and I've mentioned this before. There it is. There's that last. Here was the we were already 3 months into an intermediate posture. We were getting short near-term moves, and before the posture went bearish, we had one last hurrah. That was a big, long, extended. That near-term run lasted the whole month of February. That was like one of the biggest near-term runs that we've had. Again, at the end of an when you already had a mature intermediate posture, and that was it. And we ran out of gas, and we didn't tank, but we did go sideways for multiple months because we ran out of gas. And so we've seen a move like this today, or this past few weeks. We've seen this before, and the precedent before is that at the best case scenario, we fiddle around in here for a while without enough technical momentum or technical patterns to say that we're going to keep going up at this. So again, of course, we could tank all the way back down to 24.25. There's the last intermediate low point. We could come down to 62% Fibonacci retracement. That would be close to 2,500. There's going to be some support in that area too, and of course, you're going to have a lot of support in this 38%. And that's going to seem like even just getting down to that level. Just again off of this high point, which is 26.65. Okay, so 26.65.19, 26.519. Okay, so we wanted to make sure there. A 5% drop, just a 5% drop from all-time intraday high would get us down to 25.32. 25.32 is right about here. That would be just about to the 50% retracement. That would be a 5% pullback, and that 5% pullback, I mean, that's not even bear market. I mean, you start talking about bear markets at 10% pullback. So, I mean, that would be a big move because of how big this rally has been, this intermediate rally has been. And I mentioned before, you know, that if you were to draw this trend line up to, you know, the highest close that we've had, even up to this high point, you know, that is look at the second number over here from the right. You know, we're talking about over the course of 108 days, including weekends, that's a 37.5% annualized return in this current intermediate run. That's a strong move. Coming off market sentiment that wasn't really that low point. It's one thing to get strong intermediate runs when you're coming up off a low market sentiment, but the market sentiment barely got below 70 here. So we're not, I mean, we weren't expecting a big run. We got one because, you know, nothing's ever 100% in technical analysis. We got a bigger run, and now we're getting a lot of different rotations here, kind of trying to keep it up higher. But at some point in time, you're going to run out of buyers. And as we saw this morning with the gap higher, we ran out of buyers. And at the very least, so far today on an intraday basis, we started a little bit of a pull, at least a little bit of a near-term pullback. All right, so if we take a look at the NASDAQ here really quick, give it a second here to load up. You can see obviously a lot more bearish, a much bigger engulfing pattern, and it had more of a bearish pattern on Thursday too. Its near-term line coming back down below 50 after briefly getting back above it. Still got a strong posture, still got very elevated market sentiment. The momentum line's not down to an extreme yet because of that big long lower shadow on Friday, but big engulfing pattern on the on the NASDAQ Composite, which is bearish. You look at the Russell 2000, again, kind of your leading sector. You see that not as big of a downward move as the NASDAQ, but look at that. So one day after getting long lower shadow, coming after a couple of, you know, low volatility upper shadows, boom! Look at that. Shooting star candlestick pattern. So long upper shadow, and we all know, I mean, that's a bigger one. That's a pretty big shadow for the end of an upward move. The top of that shadow is going to be resistance, so 1560. That's a bearish candlestick pattern in there. And then finally, the Dow Jones, which has been killing it lately. Again, it was actually up today, where the other indexes were down. But again, you know, you've got a strong bullish posture. You've had near-term line above 50 for multiple weeks. You have market sentiment above 91. So kind of, you know, that's a big extreme bullish move, almost parabolic move to the upside. You wonder with all these other indexes, is this one going to start running out of gas? We know industrials as a whole, not particularly these 30 stocks, but industrials as a sector have been leading. And technology has been lagging. At some point in time, you know, how long can these sectors, which don't typically lead, how long can they lead an irrational bullish market higher? Typically, it's not those kinds of stocks that leads the irrational markets higher. Usually it's the high PE, high beta stocks that draws in all the momentum buyers that leads, you know, things past where they should be. Alright, so if you look at the long-term chart, and again, we're even with today's move, look how far up above the 50-day moving average we are. So it's kind of hard to extend past. When you're already far above it, it's hard to keep extending it higher, at least at a pace faster than what it's rising. And that 50-day moving average, I mean, it's rising at a high clip. That's a strong rate. You can see, you know, we were rising at this rate before, but we never did tank here until that MACD started it to diverge and come down. You know, at the highest point of the MACD back here was at early 2014. We went a whole year in 2014, and then even 2015. By the middle of 2015, finally that MACD had come down below 50, and we had the opportunity for weakness. So we're still at the highest point of the MACD. You know, you're not going to see a lot of big volatile weakness here, according to past precedent, with the strong momentum up this high. So I want to keep reiterating that point. Here is your your MACD and stochastics, again, how bearish today is. We're still, look how far up above the 8-day moving average we are. So, you know, again, it's hard to be too bearish, but it's also hard to be really bullish either when you are this extent of the way. And you can see the MACD, again, we don't get big bearish moves when the MACD is up this high typically. So it'll start to grind down, which means you'll probably start to grind in this area, you know, up and down, but in this area here, maybe slightly higher highs, but mostly in this area, as this grinds down closer to zero and these moving averages pull back towards each other again, like they were doing earlier this month. You can see the stochastics is already falling below its moving average. So the intraday chart, again, I show this again, we filled in the gap, pretty much filled in the gap from this morning and closed just a smidgen lower on SPY. So higher high and a higher low, but closing at the low makes it obviously a lot less bullish than it could be. Not really bearish, because again, higher high and higher low, and we didn't close below Friday's low point, so not the most bearish pattern, but a slight, you know, not nearly as bullish either, because of the high was early, low was late. I mean, that's not very good. And we did get up above the 4-week high early, and as I mentioned before, that kind of puts some context behind how big this gap was. It really wasn't that big of a deal, because you take out that Friday news and you probably don't see, you know, a big gap today. You probably see a little bit of a move higher, and then what happened the rest of the day. And so it looked like it was such a big deal. We gapped up so much. In fact, it probably would have been worse if we hadn't had this news, because it probably would have been a little bit more irrational how much we could have gone up. But this kind of took a lot of the air out of the balloon going into it. So by the time, you know, the balloon kind of loses, you know, its air, there wasn't as much to lose. And so it didn't, you know, in this case, only what we gapped. So not nearly as big of a deal as it could have been. But that being said, it was at 2 3/4 point range today. The volume at 93 million. So you put that in, not as big as Friday's volume, but you put that in context, 93 million still off that chart. So it's still bringing the average up. The trading range still off of its chart. That doesn't mean that that can't go higher, because the 1.75 points, you know, we've been here before, but we've also been at 2 points and 2.5 points and 3 and 3.5 points trading ranges before. So, you know, as these lines keep going up, you'll see it's going to be, you know, you'll see that we've had this kind of move. Now again, we didn't have that kind of move here, at least in 2015 and early 2016. The last time we really took off on these trading ranges, and really it was the middle of 2015. Remember, we didn't get that move. You know, we were starting to move up higher. We were starting to get higher lows, similar to what we got there. But the MACD had shrunk before we got a big spike. So I wouldn't be surprised if we got up to like 2 points maybe before we start to grind and bring that line back down again. You know, maybe get up, you know, this average volume might get up to that 81 million, 83 million before we start to grind and bring that average back down again, especially as we head into a seasonally bullish time in the market. So it's, again, like I mentioned before, you know, we're typically bullish in December, and we might have had all of December's gains in the last couple of weeks. The VIX rallied here. We started, it gapped down actually this morning, got down again, continued its move lower to below 1050, and then started to move back higher again. So you can move this, we can duplicate that, bring this back down into this area and change that color. There we go. So you can see slightly higher high in the volume coming off of this big gradual move, more gradual move up, and then of course the spike on Friday morning. But now you can see if this ends up being a low point, it would be a higher low point. So we're starting to pick up on the volatility, not just on an absolute basis, on a relative basis. You can see we're gradually moving. That sweet spot's at 85%. So until we really break that 95% and close up there, which we haven't done in a while, you know, the last few times we've had closes above 95%, they've been really extreme. You know, you can see where the opens are and how big those extreme was. This is on the daily chart. So we've obviously haven't had extremes like that here. But if we do, if we get kind of gradually move and close up above this 90-95%, which is your neutral area, then you can see that will be bearish, because we don't, it doesn't do that. Usually it gets up in there and doesn't last intraday and comes all the way back down just like that. All right, well, let's transition into what's driving the price action today. And just another quick reminder again to like here and retweet. Today's we got over 100 on Friday's Market Outlook tweet. That's always pinned to the top of my timeline. There's the address to get to my feed. If you're not following me, there'll be a follow button right over here on the right. Click on that. But the more you like and retweet, the more Twitter will keep pushing you all of my tweets, so you can make sure that you're getting all my stuff. And for my benefit, the more that you like and retweet this, the more they'll keep pushing my stuff out to all my followers. They'll be able to see because it's a highly engaging tweet. So I really appreciate the fact that we eclipsed the 100 mark. So thank you, and keep doing that. So let's take a look at what's moving the market. So you can see again, small cap stocks have been doing really well, and they started the day strong again today. Crude oil had a good day early, but it was down. Down, or crude stocks were up early, including Halliburton. We talked on Friday. But by the end of the day, you can see crude oil back down more than 1.5%. Small cap stocks started the day better. Emerging markets are up there. There's the U.S. stock market, the dollar strong. But then if I were to start at the open and work our way all the way to the close, by the end of the day, long-term bonds were the best performing asset class. Gold and the dollar outperformed. There's high yield, and you can see small cap stocks dropped the most. They had been going up the most on this Senate tax reform. So again, buy the rumor and here sell the news. Aside from that, you can see on the calendar, factory orders was the biggest thing that came out today, and actually beat expectations. Small loss compared to a little bit of a bigger loss expected. So here we go. Here's the small loss, 0.1% versus 0.4%, which is expected. But the key is this year-over-year figure, which you can see is at its lowest growth rate year-over-year of the year. One of the key components is this non-defense excluding aircraft component. That is basically your business spending here, capital goods, and you can see the year-over-year rate for that is down month over month. Is 0.3%. There's a little bit of a lag here, but coming off of 3 consecutive really strong months of business spending, that's kind of dried up. Now again, it's just 1 month, so the rest of the economic picture is looking very strong, and even from a GDP estimate standpoint, back up on Friday, back up to this 3.5% after dropping down to 2.7, and as a result, you can see the rate expectations still staying very strong. Here's one. There's December is already baked in, so that's pretty much a guarantee, as a guarantee as you can get in the financial markets. This would be 2. This would be 1 for 2018, and then the gray line would be 2 for 2018, and again by June 18th, and this line down here at the bottom, which is starting to grow a little bit, would be 3 by June. So obviously a lot less likely, but this purple line is none in 2018 by June, and now we're easily trading down at 20%. So very low probability that we will only get a rate hike in December. So the market's loving this tax reform, but how much of that bullishness in tax reform is going to be offset by now a more hawkish Fed to help offset this really dovish fiscal policy in an environment where maybe the Fed doesn't think we need that dovish of a policy. So here's the 2-week picture of the sector rotation now, and you can see again, if I just zoom in on today, early on this morning, you see financials, consumer discretionary, industrials, materials, even energy rallied up here. But from really this peak here, once we gapped up, you can see technology lagging behind the market, up but lagging behind the market, and all your other safe haven areas were lagging too. By the end of the day, you can see consumer staples was the best performing asset class, and technology dropping like a rock, healthcare dropping down throughout the day. That big tech area continues just to lead the way higher, or lower, after for multiple months leading the way higher. And I'll mention that again. So you know, when you have these sectors that lead for so long, your risk increases, right? You have these gains. Like when you enter a position, your risk is defined by that stop order. That's your trade risk, right? And as you get gains and gains, your risk gets bigger and bigger. And so you have to reduce that risk. And you can do that multiple ways. You can do it by moving up your stop as you get new supports. That brings that trade risk back into line. But you can also take profits and reduce your position by selling shares or buying protective puts or selling calls. Selling calls isn't nearly as good as buying protective puts, but you can put that in conjunction with each other to help try to be able to offset the cost of that protective put. As long as you don't think it's going to go up significantly higher past that long call, where now you're capped your gains off by that short call, and you paid for a put that you don't need that's losing value as you keep going up. So that's the danger of the collar, which is what that's called. But you can see that's the sectors that go up the most, and if I were to zoom out here over a 6-month period, you can see technology had its run, and really it's from this September, you could probably even say this August low point. When we hit that August low and took off like a rocket here, all the way up to now, energy had its run, materials had its run, industrials had some outperformance, but by just a little bit ago, I mean, just by last week, technology was up almost 14% over the course of, what would that be, from August 18th to 1, 2, 3 months. It was technology. Now, you know, S&P 500 was up, you know, what would that be, about 9%. So you had some strong outperformance, and you can see these other areas lagging behind, like consumer staples especially. But look at consumer staples and this gap here. You know how all these consumer stocks have been leading the way higher during this little rally, and then finally, since that peak on technology, down 3.25%, where the market's up 0.5%. And you can see the gain in energy. We focused on energy in Friday's video. Financials liking those higher yields. Consumer staples rallying after significant underperformance. So, you know, what goes up the most will come down the most once there's any hint of profit taking. And that leads us into our trade idea of the day, and I want to take a look at one of the big names in that technology sector, which is Microsoft. And Microsoft has been pretty flat, hasn't been caught up in this downdraft of this past few days until today. Today, 3 red arrows. You have the phantom red arrow on this stochastics. The MACD is down. If I take a look at the 2-line versions, you can see how those lines got smaller and smaller. And we talk about that. Usually the MACD will grind towards 0 before, and it doesn't really drop sharply. It usually jumps up quite a bit when you're down below. So it was grinding. We got that breakout below 82.5. Starting to fill in this gap here. MACD is obviously still below its moving average. Stochastics breaking down below its moving average. You look at the market forecast indicator, you can see the momentum's not hitting an extreme low. That would be below 5%. Intermediate posture is turning down. Market sentiment is high. So, you know, so again, we typically don't tank from really strong high levels, but you know, we can, like we did with the market, we can kind of grind away here. And we've obviously got some resistance at 85, but, you know, which, you know, again, we've talked about before, those long upper shadows, especially when you gap outside of these Bollinger Bands, which when you get extreme moves, in this case off that earnings, that ends up being a resistance. We traded all through that range. You've got some resistance there. You've got resistance at the gap. Now that we're both below that at 82.5. So we can say, okay, what if we were to come over here and sell that call at 82.5, buy the 85 for protection in case it takes off. But you notice, like right now, that the current price is way more than what I need for a good reward to risk ratio on a $2.50 wide call. Because remember, the higher the credit you get, the lower the probability of success you get. And with vertical spreads like this, which is what this is called, when I'm selling a call and buying a call in the same expiration, just at different strikes. When you're doing a vertical spread, the goal isn't the highest return possible. The goal is the highest probability of profit possible with enough return to justify the risk. And so, you know, for a $2.50 wide spread, if you're looking for that 30% return on risk, then you're looking for a credit of about 60 cents. That will give me a 30% return on my maximum loss. Now again, we might not, most likely won't take that maximum loss, but you can also see too that for the market to get that, we have to keep going down a little bit. It has to keep going down to below 80, right? 81 right now. So this will kind of make sure the stop limit order, use a limit order if you want the trade to pull back some. So you remember, I want this to go to 0. So if it goes up and pulls back some, then you'll use a limit order and say, okay, I'll get in, but I want to get in at a better price for me, right? Get more credit. In this case, I don't want more credit. I don't want a better price for me. I want to make sure that Microsoft is going in the direction I want it to go, which is to the downside. You can see $1.18. So for that to happen, then I want to use a stop limit. A stop limit says I want the price of my trade to already go in the direction I want it to go. I want it to go from this 71.84 area to 0. So it's right now at 84, so I want it to go closer to 0, in this case down to 60 before I get in. So I'm going to use a stop limit instead. So that sets me up for a move down to 80, and you can see, you know, that's kind of where we have to get below 80 before we get in, making sure it's going to keep going down. And as long as it stays below 82.5, then we make our trade. If it gets up above 82.5 or gets above 85, so if I were to analyze this trade, throw it on this here, and get rid of this old trade from back here, then you can see if we do get up above 85, so let's set our slice to break even on this, and there's our 85 level. Well, if it gets up above there tomorrow, then I'm going to lose $87. I'm not going to lose the full 190. And I don't have to wait for it to come back down, because if you're breaking through resistance, there's a good chance it will keep going up. And, you know, my time decay is working against me as that line pulls down there. So we don't, you know, if it breaks, in fact, if it breaks above 82 and kind of doesn't hold this breakout after having dropped below 80, because remember, we don't get in until it drops below 80. So if it drops below 80 to fill us in, and then comes all the way back up and gets above that resistance at 82.5 and say gets up to 83, now you're seeing I got about a $60, and that line's going to move up. I'm going to get about a $60 loss, $55 right now, that will get smaller as time moves on, versus a $60 gain. So you see, I'm not really going for a 30% reward on risk. I'm going to take a small loss if the stock doesn't do what I expect it to do. And again, that's the key to success on these quote-unquote high probability strategies, is you have to have a way to get out with a small loss, so that you don't ever take the full maximum loss. So because I've mentioned this before, and I'll mention it again for those that are new, if you take the full $190 loss and you're trying to get a $60 gain, that means you have to, with comparable trades, you have to have 3 consecutive winning trades, maximum gain trades, just to break even. So that's 4 trades with 3 consecutive gains in a row. The odds of getting 3 consecutive MAC gains in a row, and one of them, just getting one, is 60%. You know, you multiply 63 times 63 times 63, it's not a high probability that you're going to get 3 in a row. So, and that's just to break even. So you can see now, the break even after maximum loss is going to take 5, 6, 7 trades potentially just to break even. And, you know, which might mean, yeah, that doesn't sound like too much, but remember, those are all commissions. So in reality, it's going to take 8 or 9 once you account for commissions just to break even from a maximum loss. So that's why it's so terrible to do that. And that's why, for those who have taken it, it's hard to get going again, because it's a hard thing to overcome with these small, piddly maximum gains. So we have to have a way to take a small loss when we know the trade's not doing what we expect it to do. Here, it's broken through support. I don't need to keep going down, but I need it to hold this old support, which is now a new resistance. I need to hold it for a new resistance for me to make my money in this trade. As long as it does that, fine. If it doesn't, and we break back above, again, only after we get filled in, which means we have to drop below 80 to get filled in. If it drops down and can't hold that for resistance and gets back into this area, then the purpose for being in this trade is not there anymore, no matter what it does going forward. It might continue to drop. Who cares? But if it goes up and keeps going up and up and up, and I take a $190 loss, that's not worth it. that is not, the $190 loss is not worth it for the $60 maximum gain. But a $50 or $60 a loss definitely is worth it for a $60 gain that has a high probability of getting it. So to summarize, the market started off this morning strong, probably not as strong as it seemed, only because of the news that came out in the middle of the day Friday that was quickly erased by Friday afternoon, and obviously the gap this morning. And we saw that the market wasn't able to hold the gains from this morning, and we already started to pull back a little bit. So, and we've seen some strong rotation within today's intraday move that's starting to tell us that, you know, there's some weakness coming from the market. Not trend, not bear market weakness, but at least, you know, not nearly as bullish as we've been weakness, to the point where, you know, taking off risk, reducing position sizes, being more, being less aggressive with our directional trades until we get more of a pullback that gives us a better launching point. And, you know, again, considering the time of year, you know, that may be coming by the end of the year. But until then, the markets are telling us, slow it down a little bit. You know, let's take some profits and see what happens for the next little bit and look for that better entry. As always, thank you very much for watching tonight. Remember to subscribe, like, and comment on today's YouTube video. Also, for those of you who follow me on Twitter, remember to like and retweet today's tweet. Keep getting my stuff. That's the best way to make sure you keep getting my stuff there. Again, have a great evening, everybody, and we'll see you all tomorrow.